All right, hold up. Before we dive into the wild ride that is this week's global markets, I need to tell you something crucial. If you've been feeling that knot of anxiety in your stomach about your money, wondering what the heck is really going on with the economy, then you cannot miss what's coming next. We're talking about a paradox so strange, it's flipping everything you thought you knew about investing on its head. Most people will completely miss the signs, and trust me, you don't want to be one of them. Stick with me until the very end, because by the time this video is over, you'll have a crystal clear picture of what's actually driving the market right now, and what's about to happen next. This isn't just about understanding the news, it's about protecting your financial future. So, if you're ready to get ahead of the curve and unlock the secrets of this crazy market, hit that like button right now. It tells us you want more content that cuts through the noise like this. And whatever you do, do not click away.
All right, let's dive into the global markets, because this week, something really weird happened. We're talking about a massive paradox, a real head-scratcher that's playing out all over the world.
And here's the big question at the heart of it all. Is bad news now good news? I mean, seriously, that one question basically drove every single major market move last week. And believe me, it is setting the stage for a huge showdown.
So the best way to picture what's happening is to think of it like a giant global tug of war, okay? On one side of the rope, you've got all this data screaming that the economy is slowing down. But on the other side, you've got investors pulling like crazy, actually hoping for that weakness, because they think it'll force central banks to jump in and save the day with a flood of cheaper money.
Okay, so to really see this tug of war in action, let's start with the US, because one side of that rope just got a massive yank last week, all thanks to a jobs report that was, frankly, a total shocker.
Okay, just look at this number, 22,000. That's it. That's how many jobs the US economy added in August. To give you some perspective, that wasn't just a miss, it was way, way below what anyone was expecting. A genuine jolt to the system.
And because of that, well, the unemployment rate ticked up to 4.3%. Now, this isn't just some tiny little bump. This is the highest the U.S. unemployment rate has been since all the way back in 2021.
But honestly, the real gut punch was buried in the fine print. When the number crunchers went back and revised the data for June, they found the economy actually lost jobs. That's the first time we've seen a negative number, a net job loss, since the craziness of 2020. So you see, this wasn't just one bad month, it's a sign that this slowdown might be a real, deepening trend.
And look, this wasn't some isolated incident. This wasn't happening in a vacuum. You had U.S. manufacturing shrinking for the 6th month in a row. The Dow Jones Industrial Average was down, and yeah, some of the smaller stocks actually went up, but, and this is key, it was only because of those hopes for a rate cut. Every single sign was pointing to an economy that's really losing steam.
So you hear all that, right? All this terrible economic news. You'd think the markets would be in a total panic. But this is where our tug of war gets really interesting. Instead of panicking, the market saw all that bad news and just started pulling even harder on the other side of the rope. That hope for a rate cut lifeline.
So what's going on here? Well, it all comes down to something called rate cut expectations. And it's really just a big bet. It's the market gambling that the Federal Reserve is looking at all this bad data and thinking, oh, we've got to do something. And that something is cutting interest rates, which makes money cheaper to borrow for everyone. Businesses, people buying houses, you name it. The idea is that this will give the whole economy a jolt.
And you could literally see this bet playing out in real time. Investors got nervous and started what's called a flight to safety. They just piled into things like U.S. government bonds, which are seen as pretty much the safest investment on the planet. And that caused their yields to plunge. At the same time, they were snapping up gold, another classic safe bet, pushing its price to a record high. Classic signs of market jitters. And just look at how certain the market is about this. Right now, investors are pricing in a 100% chance of a rate cut at the Fed's next meeting on September 17th. It's not a question of if, it's a question of how much. 86% are betting on a standard quarter-point cut, but a growing number, 14%, think the Fed might go even bigger with a half-point cut. So yeah, bad news has officially become good news.
So who loves the idea of cheaper money more than just about anyone? Tech companies, those big growth-hungry tech companies. And sure enough, that hope for a rate cut was all it took to send the tech-heavy NASDAQ index soaring up over 1% for the week. All this while the rest of the economic news looked absolutely terrible.
But here's the thing. This whole tug of war, this fight between a slowing economy and the hope for a central bank rescue, it isn't just a U.S. story. Not at all. It's happening all over the globe, but everyone's story has its own little twist.
Let's take a quick trip around the world. You've got the Eurozone and the UK, where central banks are basically hitting pause. Things are a bit fragile, so they're just waiting and seeing. Then you have China, where they're still battling deflation fears and a shaky property sector, major economic headwinds there. But the one that really stands out? Japan. I mean, for the first time in forever, they're seeing strong wage growth, up over 4%, and their central bank is getting ready to do the exact opposite of the US. They're talking about hiking rates.
Okay, so all of this, everything we've talked about, it's all leading up to next week. And it is shaping up to be a massive showdown. Why? Because there is one single number that could finally decide who wins this round of the tug of war.
And that number is the CPI, the Consumer Price Index. It's basically the big one when it comes to measuring inflation. Think of it this way. If the CPI number comes in hot, that means inflation is still a problem, and the Fed's hands are tied. They can't risk cutting rates. But if that number comes in cool, it means inflation is under control, and that gives the Fed the green light to come in with that rescue plan the market is so desperate for.
And just look at the schedule for the week ahead. It is absolutely packed with market-moving events. We've got key data coming out of China, a rate decision from the European Central Bank, a GDP report from the UK. But let's be real. All eyes are going to be on Thursday. That's when the US CPI number drops, and that's the one that really matters.
As one source put it, and I think this says it all, the upcoming US CPI report and ECB meeting will be pivotal in shaping the September narrative. Buckle up. Couldn't have said it better myself.
So, that's where we stand. It all comes down to this. The market has made its bet. A weak economy is good news as long as it means a rescue is on the way. But that entire hope hinges on one thing. Inflation has to play along. So the big question heading into next week is simple. Will inflation be the hero of this story, giving the Fed the green light, or will it be the villain that shatters everyone's hopes? We are about to find out.
If you found this breakdown useful, hit like and share it. It helps more people discover MacroNav. And if you want more clear, no-nonsense explainers on global macro and finance, make sure you're subscribed. Stay ahead, stay informed.